12-month contract, and I realized that all of the profit of that contract was recognized for the first 6 months, and there was zero margin in the second 6 months. Well, all of a sudden, I'm going to restate the profitability of that contract. That can have wild swings on the amount of accrual basis EBITDA that goes into evaluating a business. That can have some very negative surprises when the restatements happen, and that type of concept can be somewhat foreign to owners that don't know how this should be reported.
Hey, excited here to welcome everyone back to what is one of the early episodes of the Source Code podcast, and we're really kind of continuing our theme of diving deeply into kind of specific segments of middle market investing, operating, or just deal making. And we're excited to have Matt here from CFGI. I'll let Matt kind of introduce himself. After that, we're gonna briefly talk about how we met, our history, and Matt's, and then deep dive into Q of E's. So Matt, I'll pass it off to you.
All right, fantastic, Tomas. Thank you. So my name is Matt Estadt, and I am the managing partner of transaction services at CFGI. We're a 25-year-old company headquartered out of Boston and currently have 32 offices spread throughout the world, 17 in North America, 14 in Western Europe, and 1 in Asia. And I've had the privilege to start and then grow the transaction practice here. In the early part of my career at Arthur Andersen and PwC, doing mostly the same thing. I started, as you might suspect, for a handful of years in audit, but that's a pretty traditional starting point for somebody that then transitions into the transactions field.
Yeah.
Yep. Sorry, go ahead.
No, I was going to say thank you for that. And Matt and I actually know each other because about 6 years ago now, when I started the sponsor and we were doing our first deal, Matt actually did the Q of E on our first 2 platforms, and they were both heavy contractor-like infrastructure service companies where it's a pretty complicated process of completion accounting, and it can be a little tricky. So really developed a lot of respect for the work that he did, and we've stayed in touch over the years here. So excited to really dive into Q of E's.
I think actually that the initial relationship we formed there, Tomas, also points to the value, and I know this isn't the direct topic of this podcast, but it points to the value of long-term investment in networking, because Daniel Kobayashi, who connected us, I first met him 9 years before we started working together. And so we had kind of kept in contact that entire time. Finally had an opportunity to pitch on something, came in and was able to win the work. And here we are today. Anyways, that's another part of the story of building the practice from where it was when I started it almost 14 years ago to where we are today.
That's awesome. Yeah, and it is true. I think you never know when your opportunity will come up in those relationships, and you just have to grab it when it does.
Yep. Yep, absolutely.
Well, I guess to start, could you just talk about, at the highest level, right, what a Q of E is, what the goal of it is, and really when it is used?
Sure. So a quality of earnings analysis, and that's the general term for, I'd say, a broader financial due diligence analysis, that is used typically by private equity firms or any company that is going through an acquisition, generally either buying and selling a company or selling a company, to make sure that what a company thinks they are buying or thinks they are selling holds up to scrutiny by third parties. If you're thinking about it in the context of buying a company, we are typically engaged by private equity firms, independent sponsors, after they have come to a preliminary agreement through a letter of intent, a non-binding letter of intent that has been based on, I'd say, higher level financial information that has been exchanged by the buyer and the seller of the businesses to come to that non-binding agreement. At that point, the floodgates opened, and then we, or any other third-party due diligence provider, really get ultra detailed in terms of our review of the financial information, even going down to the transaction level of detail, chart of accounts, and we really beat up the financial data for the last 2 to 3 years, depending on the exact time period our clients are interested in, to make sure that they have a view on normalized operating cash flows of the business that they're buying, That's typically defined as EBITDA, earnings before interest, tax, depreciation, and amortization. The other key analyses are always surrounding net working capital, making sure that a business is going to convey an appropriate level of net working capital to continue to run the business post-closing. Net working capital is another proxy for operating cash that a business will be generating. And then the third key pillar that is always included in that analysis is an analysis of indebtedness, or debt and debt-like items is typically what it's called. And these all feed into the purchase agreement in a variety of different ways. But those are the three analyses that are included in every financial due diligence analysis, regardless of industry. In my experience, it expands healthcare, industrials, technology, you name it. And then, of course, as you get more deeply involved in the specific companies or the specific structure of the deals, there are a variety of different analyses that you're going to drill into. So for technology, you're going to be looking at different KPIs. So ARR type of metrics or different KPIs of customer churn, cohort analysis. Healthcare, you're going to get really deep into the billing analyses, the payer rates, things like that. And then obviously you're going to be doing your basic financial statement fluctuation analyses, diving deep into the income statement, the balance sheet, to come up with a holistic view of the businesses that can be presented to the clients in a quality of earnings report.
And when you think about a quality of earnings, what are the major things that most clients are looking for in terms of when they open the report? What are the first things they're going to?
The first thing that they always go to is the quality of earnings table, which is typically very close to the front of the report, maybe right after the interest slides. And they want to compare the adjusted EBITDA number in the trailing 12-month period to the adjusted EBITDA number that was in their letter of intent, to make sure that those line up pretty darn closely. Because if there are any major discrepancies, especially on the downside, there's going to have to be some type of renegotiation on the purchase agreement, or shifting part of that consideration to a more creative earnout structure, in my experience. Ideally, that's not going to be the first time the client sees that discrepancy. There should obviously be regular communication along the way, so there's no surprises at the end. There should be red flags, so there can be a pause or renegotiation much earlier in the process than after we're done our work, because our work feeds into other diligence work streams, legal certainly being the most prominent one, but not the only one, that happen later in a transaction cycle.
And how do you think about your viewpoint on some business versus kind of financial decisions where, add backs, for example, something where there's some degree of subjectiveness about what is real and what is not? How do you navigate those waters?
That's been, in my experience, that's been kind of a moving target in the 23 plus years that I've been doing this work. If you go back to the beginning of my career, there was a pretty hard line in the sand in terms of what was correct and what was incorrect in terms of an acceptable diligence adjustment, meaning there were one-time items, there were changes in the business that had already been observed, and you could sort of remove the impact prior to of those business decisions prior to that change being made. Those were traditionally diligence items, if you wanted to think about it, 20 plus years ago. These days, we see a lot more pro forma considerations making their way into quality of earnings reports in one way, shape, or form. A lot of post-closing changes that are going to impact EBITDA. There's different ways to present those in a quality of earnings report. A lot of times we will present due diligence adjusted EBITDA, and then we will layer in, at the request of our clients, additional pro forma adjustments to come up with pro forma adjusted EBITDA. And of course, there's always the normal kind of back and forth of the management team of the company that is on the other side of the transaction, trying to defend some of their proposed adjustments, which in a lot of cases relates to synergies that would be realized by the buyer of a business that would not exist if the company continued in a standalone fashion. So a lot of times we see, add backs for duplicative headcount or renegotiated insurance coverage or healthcare benefits, something along those lines that the management teams often try to take credit for that are a pretty regular area of contention in the negotiations.
Yeah, I've always loved that. Like, I'm going to get credit for these future things that will happen
Right,
because of what you
right,
have in here.
exactly.
Yeah. That's a strong move that I just appreciate.
And the funny thing is the deal market these days has gotten so incredibly competitive that we're seeing, quite frankly, a little bit more movement on buyers accepting those to get deals done. Something that 5 years ago I would have been really surprised at, but we see it more and more often.
From someone that's been in the position where QAV doesn't come back where you want it to be, right? You sometimes are committed to the deal in ways where it's hard not to find yourself, doing things that become grayer, right? Like um, it's competitive landscape, and when you get a good one, you really want to find the reasons to say yes as opposed to no. But that's often what makes a good investor.
Yep, absolutely.
Um, so I guess when you think about the other kind of major contention point of QAVs, the things that really jumps out to me is the networking capital.
Mhm.
And can you talk about why networking capital is one, in my experience, a point where deals break? It's one of the main points where deals break, and why it is so important to both sides.
Sure. To start off with, most deals are structured on a cash-free and a debt-free basis, meaning that as of the day of closing, the existing owners are going to strip all the cash out of their bank accounts. So as a buyer of that business, you're not going to be able to tap on existing bank accounts to fund your operations day one. So what that means is that oftentimes maybe a buyer will put in a short-term line of credit to cover operations for a couple of weeks until the business starts generating cash flow on its own. But what that really means is that you need to make sure that you are setting a net working capital peg, which really the definition is current assets minus current liabilities, where the business is going to start generating cash flow within the first week to 2 weeks through the collection of receivables, the sale of inventory, offset by normal payables, accounts payable, regular accrued expenses. Whereas you are not going to have to be funding the operations of that business for an extended period of time if you are the buyer of the business. That's why it's critical to make sure that you are negotiating net working capital correctly, because otherwise you can come and find yourself in a position day one where you're going to have to fund operations. And then the second point that can really turn into an issue, and this is more critical post-closing 60 to 90 days out, is that if the net working capital peg is set incorrectly, and this can happen for a variety of reasons. I don't know how deep you want to get on this podcast, but if the peg itself is set incorrectly, and then as of the date of closing, when that is remeasured post-closing, the remeasurement comes in wildly different than the peg amount, you can have a very, very significant true-up that's due either to the buyer or to the seller. And the whole intention of getting the peg correct is to have a minimal true-up post-closing. And for anybody that doesn't understand exactly how this works, the net working capital peg is typically set based on adjusted balance sheet accounts, taking into account any unusual items identified during due diligence that should not be included in net working capital. So, for example, if I'm looking at net working capital and I don't know, $100,000 worth of AR that's aged over a year that hasn't been reserved for, it's probably not reasonable to expect to collect those in net working capital. So that should be excluded from a net working capital peg. Same thing on aged inventory, obsolete inventory that you're not going to be able to sell. That should not be included in a net working capital peg, generally speaking, because when you go and remeasure that post-closing, then you're going to have adjustments for those items that are going to be a surprise post-closing. There's a lot of different ways you can think about this, but the ideal scenario is where the remeasurement post-closing is very close to the peg amount set pre-closing, and there's a minimal true-up.
Got it. No, and when you think about the time frame of kind of net working capital analysis, I think that's another point which can often be debated. How do you recommend people think about the correct window to look at?
It depends on how mature the business is that you are evaluating. If the business has been growing a lot, and I should preface this by saying The starting point for most people is looking at a trailing 12 months average of net working capital. Just traditionally been a normal way to start the evaluation. But if a business has been growing significantly or shrinking significantly, realistically speaking, a trailing 12-month average is not going to give you a good picture of what you're expected to get as of the closing date. In that situation, more often you'll be using a trailing 3-month average. In some situations, you're actually trying to develop a forecast of where you think net working capital is going to be as of the closing date. That's a little bit tricky, to be perfectly honest with you, because the way you document a methodology that both sides will sign off on to set a net working peg that's going to be based on forecasted amounts can be contentious, and I've only seen it happen in a handful of cases. In a stable business, trailing 12 months is probably fair. In a rapidly growing or shrinking business, trailing 3 months or maybe even trailing 2 months is probably more fair. And then, of course, in a business that is highly seasonal, has very large peaks and valleys of their average net working capital during a year, typically you're going to want to make sure that you're setting your peg at an appropriate amount based on when in the year you're going to close. So right now, for example, I'm working with a variety of businesses where most of their revenue comes from school districts, and school districts generally operate 10 months out of the year. And your working capital levels are very consistent from August through May, generally speaking. But if you close in the summer, there's very little AR for those businesses in June and July, and sometimes in August. So that's why we generally try to stay away from 12-month averages if you're looking at a business with any seasonality.
Got it. And I think that's one of the points that makes these so contentious is there's often no right answer. It's about how you can kind of defend and position where you're situated, and you're often just trying to figure out which levers you can pull to make you both the least unhappy.
And the other thing that's I'd say very complex, or can be very complex in lower middle market deals, is the lack of sophistication in accounting records, because most small companies, they use some form of either cash basis accounting or a hybrid of cash and accrual basis accounting. And what that means is that if you're actually looking through at net working capital through the lens of any sophisticated investor and what that should look like in terms of setting a peg, nobody's going to be willing to set a peg based on cash basis numbers or numbers that don't accurately reflect what the cash is going to, what net working capital should be in an accrual environment. So that means you have to define a methodology in the purchase agreement that makes sense to the buyer and to the seller, because a lot of times these concepts are very foreign to sellers, especially to founder or owner operators or people that have only managed the business through their bank accounts historically. So there tends to be a fair amount of art that goes into establishing something that is understandable enough to sellers that kind of fit that profile, first generation type of sellers.
Yeah. I think, again, all of these are based on the data that goes in, right? And sometimes that data is not as accurate as you would like.
Yeah.
So when you think about independent sponsors, new funds, people where you don't have an institutional relationship with QOB providers, when you're at a large fund, you typically have, a bench of ones that you work with. They'll respond quickly, make you a priority because, you're part of a large institution. But when you think about hiring the QOB provider on your early deals, what do you think you should be looking at? What should you be considering, whether it's sector experts, whether it's team size, and how do you think about that?
Sure. And actually this resonates, pretty nicely with me, this conversation, because when I started the practice here at CFGI 14 years ago, the provider landscape of people that do quality of earnings work was very different. At that point, it was, for the most part, only the big four where I came from. And then the second tier nationals like RSM and BDO were doing this work out of their major financial hubs, generally New York, Chicago, and somewhere on the West Coast. And I had the opportunity to start a practice that was squarely focused on the lower middle market. And it was really just me for the first 2 years. And the way that I went out and I got to know either independent sponsors or very lower middle market private equity funds, generally funds that we're investing at the time out of. Maybe $200 million funds at the high end of what I was targeting. Is I targeted, or I pitched myself as a sector expert, because when I was at PwC, I worked extensively on healthcare and industrial clients. So I went to market with that background, and I tried to, for the most part, target funds that were investing in those spaces so I could come across as being credible and having the expertise, and I could hand out my quals that directly related to the type of investments they were evaluating. And then the other thing that was obviously super important was flexibility, because there's a lot of risk as an independent sponsor in terms of not having funding to run or to get a deal closed without a dedicated fund where you have management fees. You're dependent on your LPs, deal to deal, or a special purpose vehicle. And so you need to make sure that you can find somebody that has the right amount of qualification doing this work, not somebody that kind of does it part-time. Because if you really drill down into some people in lower middle market firms that claim to be transaction professionals, what you'll find is that 70 to 80% of the time they might be doing valuation work, and maybe 25 to 20% of the time they're doing quality of earnings work. And in my experience, that just doesn't translate well. So make sure that you're really doing work with somebody that may have spent a lot of their career at one of the big national shops and is now working out of a smaller shop, and they can afford to invest at a much lower price point, and they can be flexible on deal terms. So meaning they don't need to get paid in 30 or 60 days. They can get paid at closing. They can be creative in rolling fees. They can take significant dead deal haircuts on fees. And that's what I did for really the first 2 or 3, even 4 years that I was at CFGI. I mean, it was just me for the first 2 years, and I had, I think, 3 people by the end of year 3. And we were out there, we were doing good work for low quality. We were building our brand. And even today, I mean, we work on roughly 300 transactions per year with about 40 people on the team, but probably about 15% of them are still with independent sponsors. So we still know how to get that structure to work in a bigger environment.
Yeah, when we were doing our first deals, they were, one, larger deals that were more complex, so there was more associated diligence costs. But one of the things we were able to do was get every provider to agree to be paid at close. And I think that's a huge lift for independent sponsors that are able to do that. But with the market getting crowded, and I think, there's less willingness to some degrees among service providers to do that. So when you think about an independent sponsor approaching you, trying to get you to commit to, basically pay on close with favorable terms to roll into the next one, if it doesn't, what makes you willing to do that? What are you looking for in a potential sponsor or a partner that would cause you to kind of accept those terms?
What I'm looking for in a potential partner is somebody that is going to be very focused on volume in that particular case. So if I know that the thesis that this team or this independent sponsor is going into this investment with is going to be 5 to 10 bolt-ons, well, I don't know, maybe 5 bolt-ons per year, that's something that I'm going to be willing to invest in heavily. And actually, we have a number of clients to this day that are doing a lot of bolt-ons, and we're willing to have pretty generous terms for rolling dead fees or dead deal discounts, because we know that we're getting 10 deals per year for them. So we can afford to write off a fair amount of fees on 1 or 2 deals if they don't close. You want to find somebody that is very, very interested in forming a long-term relationship, because deal to deal, whatever fees you're going to get out of a single deal or maybe 2 deals pales in comparison to what you're going to get out of a 10 to 15-year relationship. So I would be very focused on understanding, the background of the people that are running the independent sponsor. So 2 of my independent sponsors right now, for example, one of them was a former partner at Carlyle, and he's set up his own independent sponsor shop, and great track record, and I've seen what he's done over the years, so made me feel very, very comfortable with that. But another independent sponsor used to be a senior associate at a private equity firm that I supported 12 years ago, and then he went on to go into more and more sophisticated PE firms. But we never lost touch, and he came back to me as soon as he put out his own shingle, and now we're working together on small deals again. I mean, we're talking about $1 million EBITDA, transactions, maybe $10 million in enterprise value. But because I've had such a good working relationship with him and I trust him and his integrity, I'm willing to make the investment in that relationship, even though generally speaking, we're up market from those type of deals these days.
Yeah, and I think that's a great next topic is talking about deal size to provider. I don't want to say provider size, but provider scope, provider pricing, provider capabilities, and what people, when they're hiring a QOV provider, need to think about. When we were, again, I'll just kind of revert to some of my experiences here. When we were doing our deals, we were largely looking at, institutional LPs. So a big thing for us was we needed somebody that had, the expertise and also the brand where they would consider it credible, right? And that was really important to us, and one of the real reasons we ended up working with you. But maybe you could just talk about in a platform versus add-on. There's a very different queue for a $750,000 EBITDA HVAC add-on to a $15 million EBITDA new healthcare platform. So can you just talk about how you should think about that size, scope, and relationship with the provider?
Sure. And to your point, I'm not sure if I mentioned this earlier in the podcast, but today we are backed by CVC and Carlyle, and so that has credentialized us quite a bit in the eyes of the private equity community, and conversations have gotten a lot easier for us over the past 7 or 8 years because of that. For private equity firms that are doing their platform investments, by and large, even funds that are investing out of maybe $500 million vehicles, they are still being directed by their institutional investors, their LPs, to use, generally speaking, the big four for those type of deals. It's almost written into their fund documents that they have to do that. And if I'm looking at our universe of roughly 300 deals per year, maybe about 10% of those are platform deals. But that's quite frankly okay with us because the volume is really in bolt-ons anyways. So going back to your question about how does a platform QOV differ from a bolt-on QOV? In a platform, there's no room to cut corners anywhere, even for things that on the surface might seem a little bit immaterial. When you're talking about financial due diligence, tax due diligence, I mean, you have to be 100% buttoned up to get your risk level down to almost zero, at least as far as it goes with the quality of earnings and the financial due diligence aspect. Of course, there's still risks in business diligence and other things that are a little bit outside of the scope of what we do, but those can be measured risks based on a lot of different factors. When you're talking about bolt-on transactions, the dollar value risk is a lot lower, so you can be a lot more selective with either a phased approach to due diligence, trying to hit critical areas, red flag areas in phase one, and do things that are more confirmatory in phase two. So you can have a structured, a much more structured fee agreement documented in an engagement letter. Or in some situations, our clients push to do a lot of stuff in-house if they can do that, and then only ask us for a very basic proof of cash analysis for their smallest deals. That doesn't happen all that often when we're doing that limited amount of work. Just a proof of cash analysis, which really just takes the company's internal financial statements and then kind of reconciles those back to third-party bank statements to make sure that the cash going in and out of a company's bank accounts is in fact real. It doesn't really give you much more context outside of that. But maybe 5 to 10 times per year, we're asked to do that, and we can do that pretty efficiently at a relatively low cost. But then, again, a lot of the smaller, quality of earnings assignments, our clients don't ask us to do any type of accounting conversion. They're really just focused on only the biggest adjustments to EBITDA, lost customers, or pro forma adjustments to owners' compensation, doing some very basic conversions on accrual basis, cash to accrual basis, compensation, maybe some revenue analyses, and getting the cost down to make sure that they can still do enough to satisfy their investment committee, but not doing absolutely everything that you would want to do on a platform. And especially for our clients that are doing this type of work on a serial basis where they're doing 10, 15, 20 roll-ups per year. I mean, once we kind of get in there and we do 2, 3, 4 deals with them, we know exactly what they're expecting, and we can go in and be incredibly efficient. And that really saves time on scoping and cost and discovery each time, because there's not really much of a scale of a learning curve, I guess I should say, on each deal.
Yeah, and I think you actually hit on another great point I want to touch on there. That's something when I think, when people come from funds, they're not used to operating with constraints around price, right? And not just price, but scope, and also what to do themselves versus outsource, because, you're in an environment where oftentimes speed, certainty matter a lot more than dollars out the door in any instant, because you're, managing a huge pool of capital. When you're out on your own doing your first deal, all of a sudden, all of these things matter, a lot more. So when you're doing your first QOVs, how do you think it's best to align with the provider around what exactly you need and what will help get your deal done in kind of the most, risk adjusted kind of attractive fashion?
Sure. So to your point, the deal timelines are very different when you come from a large fund where a lot of the deals are sourced typically through an auction process. When I was at the Big Four, usually we had a 3-week sprint to get everything done. And sometimes that was generous when we got into a large and complex data room and we had to be done somewhere between 2 and 3 weeks. The deals, in my experience in the lower middle market, are much more measured in terms of long-term courting of a potential target owner, getting a little bit of information, bit by bit to start forming your view of the business and making sure that the results are kind of in line with what you are thinking is appropriate for evaluation. And then as you continue to formulate that view over weeks or months, you can then kind of reach out to somebody like me to say, hey, listen, this is what I learned about the company. This is what I want to confirm in the first 2 weeks that I want to go pencils down, because I want to make sure that there's nothing I have to renegotiate. And then I'd like to come back and confirm these 3 or 4 things. I mean, that's a bit of an oversimplification because, a lot of stuff that can be important in phase 1 has to be confirmed as part of phase 2 or 3. But that's something that is much more common when my clients call me and they ask about a phased approach. They already have in their minds what the key risk areas are. And again, a lot of times it's confirmation of cash flows and of key deal issues that they've proactively identified as part of their upfront diligence of the business. In some situations, clients are actually even asking us to get involved in a very limited capacity before they even have their LOIs in place, because they are so constrained in terms of bandwidth. They're trying to source deals. They're trying to do limited diligence on a number of different topics. We've even been engaged in very, very low-cost situations to help feed into or refine some basic valuation models for businesses because they don't have enough time to do all of the screening. So sometimes our clients will come to us saying, hey, listen, this is the model that we have in place. It's a model that we want to use as a relatively standard template across all of the opportunities we're going to be evaluating in this particular strategy. We'd like you to take these inputs that we've gotten from the target company, spend a day or 2 with them, give that to us, so then we can evaluate what that looks like. We do that relatively low cost. They'll come back to us 2 weeks later, and then we'll get into the next phase, which will take us a week. We'll go pencils down, and then they'll come back to us maybe a couple of days later and say, okay, yes or no to go to the final 2 weeks, and hopefully we'll get to a signed term sheet at that point. I'm sorry, not term sheet, a signed purchase agreement.
Yeah, and when you think about, so if you're a new sponsor or an independent sponsor or a search fund hiring your first QOV provider, you get a deal under LOI and the clock starts ticking, right? And you have a double-sided clock in a way that a fund doesn't, right? Because you not only have to sort out the deal, you have to sort out the capital. When you think about that process, right, when you should start interviewing, engaging with potential firms, what the timeline from saying is, hey, we want to go to turning on a QOV provider, what you should realistically be expecting there, and just what that process of evaluating, selecting, turning on a provider, what is the time frame? How much time do you need to give yourself, and what should that look like?
I think if you are setting up to be an independent sponsor, you should have 2 or 3 providers pre-vetted when you're even before you're starting any particular process. You should, through probably either prior relationships or referrals that you can get to people that are trusted, you should have already gone through the process of vetting a handful of firms that can probably work in the dynamics that we've already discussed in the independent sponsor environment. Typically, they might be very experienced professionals that have recently thrown out their own shingle as a Q of E provider, similar to what I did, 12, 13, 14 years ago. And they should then be, available to kind of give them a call, to give them a heads up. Hey, listen, can you have the capacity to start within generally a couple of days to a week, or the time frame that I would expect somebody would give me to get up and running? And worst case scenario, one of those firms says we can't do it for capacity reasons, then you can go on to another trusted advisor. My personal goal is that if somebody calls me and says, we need to get started on a project, I'm going to say 99% of the time, in terms of we can have an introductory call, we can do some of the basic scoping and admin work to make sure we understand what your upfront concerns are. We can do that within 2 days at the most. And then if there is a capacity concern on my end, getting that solved no later than a week. Usually that works for my clients. In some cases it doesn't, but I'd say that's pretty darn rare that cannot be somehow worked out. But that would be my recommendation. Make sure you have a couple of firms that you can call. You vetted them before you even started sourcing specific opportunities, and just stay in semi-regular contact with them, to understand what they're seeing in the market and gauge capacity.
Got it. And then when you think about both price, and I understand price is a function of scope, right? But when you think about these quick and dirty add-on kind of Q of E lights that might be done in these kind of heavy tuck-in and focused industries, all the way to a deep, $10 million EBITDA new platform, full Q of E. What is just the price range that somebody should be expecting on their, Q of E?
Gosh, I mean, it really depends on the firm that you're talking to, and I can give you, because I've actually seen these numbers. If you're talking to a regional, or a regional accounting firm that may or may not have a decent, Q of E and tax due diligence solution, I've seen some of those go for as low as $30,000 combined for financial and tax. I never really get a great sense of how good those reports are, but I think they're probably sufficient to get deals done for smaller, low risk
Depends on
type
the
of deals.
investor.
Right, exactly. Like some investors would not use those. And to your point, one of the biggest problems I had, and quite frankly, I still have today, is people knowing us as a brand name that does this type of work. I mean, the first 5 years, forget about it. Nobody knew us. We had to beg, borrow, and deal or steal, I suppose, to door. Excuse me. So for that, the lowest end of the continuum, that $30,000 fee, financial and tax combined, is what I see from really, really cheap shops. And I would say that some people, they're okay with that and they don't see it as a problem, but a lot of other people do. For the really small deals, for us, if you're doing both financial and tax, sometimes you can squeeze that in for around the 50 mark. That's pretty tight for us. More often it's, maybe 60, something like that at the bottom end. And then once you're talking more about the big four firms, forget about it. I mean, if they're talking about a $1 million EBITDA business, they're probably not even going to talk to you for anything less than $125,000, $150,000 at the very low end for financial due diligence, let alone financial and tax. And $10 million EBITDA business, you're looking at $350,000 easy for most of those type of projects.
Got it. Thank you very much for that. And I guess to switch gears a little bit, when you think about business owners preparing to sell and what the market is willing to underwrite and look at, What kind of general advice would you give to a business owner maybe 12 months, 6 months out from selling? I think there's a huge segment of the market, right, where they're just not big enough for a banker. They're just not big enough for, maybe if you're an auto shop doing 3 or 400K of EBITDA,
Yep.
and spending $75,000 on a QOV you know, is 8% of your purchase price, right? So when you just think from a practical sense from those business owners, what should they be thinking about in terms of the high level cleaning up of the books, whether it's trying to minimize ad backs or trying to collect on any outstanding AR? Can you just talk about some of those high level things that business owners could take action on immediately?
Sure. And I think honestly, the easiest thing to do is to invest in a third party. If you're not already doing it in-house, I should say, if you don't have a sophisticated or even semi-sophisticated finance and accounting function in-house that prepares monthly accrual basis financial statements, you should engage a third party accountant, maybe somebody that does your tax returns, to prepare monthly accrual based financial statements and do a compilation report at the end of the year, maybe a review report. That's not a huge cost, and it's going to save you a lot of headache by having somebody that is knowledgeable and can speak to any questions that may come up as part of a due diligence process. We're talking about a couple $1,000s a month at the most, and having that type of work done, maybe $5,000 at the most. Then going back to the operational issues, make sure that you don't have any junk sitting around your warehouse that you can't sell, that you're carrying on your books at full value. Make sure that you've collected your old accounts receivable, or you've put them into collections, or you've written them off. Just make sure you have a clean set of financials going into a transaction, and a clean set of financials that line up with how a buyer is going to look at the business. If a lot of translation work has to how a seller looks at a business and how a buyer looks at a business, again, that can lead to unpleasant surprises, because buyers are only going to underwrite accrual basis EBITDA as part of their valuation. It doesn't need to be full GAAP basis. It doesn't need to be audit compliant, but it has to be accrual basis enough to pass the valuation smell test, to get past an investment committee, I guess is a good way of saying it. So that would be my advice. Just make sure your operations are clean, and engage with your tax preparer or like a local accounting firm that can help you kind of get up the curve on how people should do this.
Yeah, and I think there's a huge element, right, of when you're doing diligence on a deal like this, you're looking for red flags in operations or finance, because red flags usually indicate other red flags, right? So if you see they've made a big mistake in one area, you either say they didn't recognize that this was a big mistake, and they've probably not recognized that other areas probably have mistakes like this, or they recognized it and didn't fix it, so they don't understand the gravity of it, right? And I think that you always just want to try and minimize any reasons to give buyers leverage. And doing some of those things you said are great ways to remove just the obvious things that you're going to look for. And I guess I would add to that, how do you think about for owners, right? Oftentimes when you are using a bookkeeper, an outsourced bookkeeper, and you're paying $3,000 or $3,500 a month, they are very much order takers in that they're not helping you with strategy. They're not going to give you advice, because they're oftentimes not very involved in M&A transactions frequently. They're mostly working with family businesses and maybe individual tax returns. How do you think about how you could best leverage that person to prepare for a sale, in order to work with them and get the most out of that relationship?
I would make sure that whoever you are working with externally is more than, I'd say, like a senior bookkeeper or something like that, because you actually can find, in my experience, people that do a fairly good job of preparing monthly accrual basis financials that have more sophistication, people that can answer questions about why were certain journal entries made, or help tell the operational story of a business, because they work closely enough with the owners to understand the journal entries, the context behind the journal entries. Because if you really take a big step back about what a due diligence process, what's the point of a due diligence process? We're CPAs. Our mandate is to understand the debits and the credits, in a company's books. But we can't do that without understanding the story behind those debits and credits. So I always like to think about this assignment as being, an operational due diligence lens through the context of the numbers, because you can't restate the numbers unless you understand the story behind them. So my advice is make sure you're not just hiring somebody that can do basic debits and credits. Make sure that you're hiring somebody that understands what you're asking them to do, and if that entails maybe doing a 1 page or a 2 page MD&A analysis or a KPI analysis for an extra 500 to $1,000 per month, I think that's also worth it. Especially if you're going to sell in the next 2 years, just take the plunge and make that investment. It's gonna pay off. It's gonna save you headaches. And just maybe, Tomas, to give a very concrete example, if you're working, if I'm a business owner and I have long-term contracts, if I'm doing construction projects that take 12 to 18 months to complete, a lot of that work is done based on initial bids and then estimates that change throughout the project. And people that
I know this
run
world
these
well.
business. Well, this is a real world example.
Yeah.
These once the projects are done, they're done. And as a business owner, all I care is that I got the right amount of cash at the end of the day. But if I'm a buyer of that company, I'm going to look at the when that cash came in, and I want to make sure I understand the profitability of the contract over time. And what happens from a seller's perspective is, well, the project's done. I got the cash, and it was as profitable as I expected it to be. Great. I'm just going to walk away. But if I'm a buyer and I look at that 12-month contract and I realize that all of the profit of that contract was recognized for the first 6 months, and there was zero margin in the second 6 months. Well, all of a sudden, I'm gonna restate the profitability of that contract. That can have wild swings on the amount of accrual basis EBITDA that goes into valuing a business. And that can have some very negative surprises when the restatements happen. And that type of concept can be somewhat foreign to owners that don't know how this should be reported. So that's why it's important to make sure that you're working with an accountant that really understands the industry that you're in to begin with to book these journal entries appropriately.
Yeah, I can't say how much stress I've had in my life looking at those and navigating some of those.
Yeah.
Well, look, we really appreciate you taking the time today and look forward to you helping the world of deal making one QRV at a time.
That's right. It's coming back. We're very busy, and I think everybody is very optimistic for 2026. Fingers crossed.
Agreed. Well, look, thank you very much and have a great day, Matt.
All right. Thank you, Thomas. Appreciate it. Bye.